Hello and welcome to another episode of Market Watch. Today we focus our attention on the new inland revenue tax bill which is expected to come across. Taxation being always an area of interest, we decided to delve into the nitty-gritties and the salient features of what the new bill has to offer. We have with us today Mr. Suresh Pereira, who is a principal of KPMG. He has his bachelor's from the University of Colombo in the Faculty of Law. He is also a fellow of the Chartered Institute of Management Accountants, and he is also a Chartered Global Management Accountant as well as an associate member of the Certified Management Accountants of Sri Lanka. Welcome to the show, Suresh. Thank you very much. To start off proceeding, Suresh, if you could just give us a gist of what the status of the current bill is, when can we expect it to come into effect and likewise.
Okay, when it will come to effect. Okay, before going to analyze that, let me explain the current status. The bill was published on the 16th of June in the Gazette, and then it was issued on the 19th, and it was placed in the order paper of the Parliament on the 5th of July.
Right.
Now, thereafter, according to the Constitution, when a bill is presented in the table in the order paper of the Parliament, under 121 of the Article 121 of the Constitution, any person can challenge that within a period of 7 days.
Right.
So what happened here is that about 10 cases have already been filed in the Supreme Court, and as per the Constitution, within a period of 3 weeks from the date of filing the petitions, the Supreme Court must inform the determination to the Speaker. So it is at that stage that we are, and linked to that is the concept of sub judice that I have to explain. Whatever that I said today here is very much restricted, because when a matter is before a court of law, due to the concept of sub judice, it cannot be discussed in a public forum.
Right.
So I will be speaking at a very mild level, only without being controversial, trying to bring only the features of the Act to the attention of the readers.
Right. So if I think capital markets is a big focus where we will be looking at as in terms of how the new Inland Revenue Act will have its implications. What can we expect for the capital market side of things from the new Inland Revenue Act?
Okay, let me put it this way. All the stakeholders of the capital market has very much been alert and looking at the developments in relation to the Inland Revenue Bill, because there was this notion that there's capital gains tax is being introduced in Sri Lanka. Yes, the capital gains tax has been introduced, or rather is to be introduced through this new bill. But before going into the features or looking at the provisions of the new bill, let me explain the current provisions in the current Act. Well, in one sentence I can say that there are very friendly, capital market friendly tax provisions in the existing Inland Revenue Act. For instance, you can see that sale of listed shares, sale proceeds of sale of listed shares are totally exempt from income tax, irrespective of whether they are capital gains or trading profits.
Right.
And in the same way, sale proceeds of listed shares as well as interest on listed debt are also totally exempt from income tax. Now, in addition to that, let's look at even the unit trust. As I go on, I will explain this provision. Now, if you take the case of listed debt, the current exemptions, that is the sale proceeds as well as the interest, that exemption will not be there in the new bill.
Okay.
And in relation to the shares, the sale proceeds, if they are considered investment shares, will not be liable for tax. But there is some clarity needed, and I believe that there may be certain amendments during the committee stage to this bill in relation to this. Okay, looking at the unit trust industry, again unit trust industry is a blessed industry under the current Act. Now you take the case of the unit trust fund, it's liable for tax at the rate of 10%. So is the management company, whereas the standard tax rate in the country is 28%. So this concession rate or the lower rate is also going to be will not be there in the new bill.
So I think,
in addition to that, okay, if you look at the other instruments like say sovereign bonds, okay, for sovereign bonds, interest on sovereign bonds, they are exempt from income tax in the current act, and that exemption will continue in the new act as well.
I think an important point will be the definition and the clarification on the investment income, which will decide the factors between how you're getting taxed. As you mentioned, that will come across at the committee stage.
Okay, let me explain. It's not the investment income; it's the nature of the share. The third schedule to the bill, which provides for the exemption, uses this phrase, the investment share. So that's you have two types of shares, as you know, the trading portfolio and the investment portfolio. So this exemption seems to be confined only for the investment portfolio.
So most probably it could be in the form of a time period which they are looking at trading versus investment.
Yeah, that distinction is different, but what I expect is that there may be sometimes a committee stage amendment to ensure whatever the type of the share, if it is listed, then it to be exempted. But we have to wait and see. We have to keep our fingers crossed to see what the development would be.
And I think the other salient factor would definitely be the unit trust exemptions from the previous blessed status, as you mentioned, that would have some bearing going forward.
Well, I don't know whether there will be an exemption for unit trust industry, as I mentioned. Well, as the provisions of the bill stands, the 10% is going up to 28%.
Right. If you look at the banking sector, Suresh, the financial sector, looking at the capital markets does constitute a fairly notable sector across as well. What can we expect from the bill? Any changes or implications which can have impacts to that specific sector which we can talk about?
Okay, so the banks will also continue to be taxed at the rate of 28%. That's the profits from a bank will be liable for income tax at the rate of 28%. In addition to that, I think I saw two specific sections in relation to banks. That is in relation to the bad debts, deductibility of the bad debts. Now, according to the current law, the deductibility of the bad debts is restricted to 1% of the current portfolio. Now, that rule is changing, and going forward, according to the wording in the bill, it will be there's a reference to the provisioning made for central bank purposes and the guidelines to be given by the Commissioner General.
Right. Also on the taxation, as it will have implications to the individual investors. I mean, we have the institutionals and the individuals who will be investing across in the capital markets. When you look at the individuals themselves, what can we expect in terms of the new Inland Revenue Act?
Both dividend and interest is going to be liable for tax at the rate of 14%. That means the withholding tax will be 14%. Currently it's 10%, it's going up to 14%. But at the same time, there's this concept of final withholding, and in relation to individuals, this 14% will be considered final withholding.
Right, on the individual investors themselves.
Yes, but I think I need to specifically mention something peculiar or something not conventional in relation to taxation of interest.
Right.
Now, under the new act, under the proposed bill, actually this came from the budget. There is this concept of net interest being liable for tax. Now, how it works is when a interest is being paid, there will be a WHT, withholding tax.
Yes.
Under normal circumstances, what happens is in the hands of the recipient, these net interest is grossed up, and then tax rate is applied, and on the tax liability is computed, and against the tax liability, a credit is given for the WHT deducted. Right. That's the normal universal principle of taxation when the concept of WHT is applicable.
This is on the net interest, as you were mentioning.
Yes, but in this bill, in this bill or in this scheme, there's a new scheme in this bill. When the interest is being paid, it will be liable for WHT, and the net interest will be liable in the hands of the recipient at the applicable rate. So, if the person is liable at the rate of 28%, that net interest will attract 28% without credit being given to the WHT deducted at source.
Right.
Now, that goes against fundamental principle of taxation.
So basically, you're being taxed twice over technically.
Well, let me put it this way: it goes against, it's a deviation against the conventional way of taxing conventional
Individuals
taxation.
and
Yes.
likewise. I think a good area to move on would be the export sector when we look at taxation, because it does have a significant bearing to the economy as well as inducing more exports into the country. What can we expect in terms of inducing more exports or concessionary rates, or what does the new act allow for the export sector itself?
Well, export industry, whether it is export of goods or export of services, is a very important area for Sri Lanka or even for any other country. So, you see that the current Inland Revenue Act has very exporter friendly provisions. Now, take the case of exports are, most of the exports are liable for tax at the rate of 12%. Now, that that is export of goods. Now, that 12% is going up to 14%. Not only that, that 14% will be applicable only if the company is engaged in the company's total product portfolio is exported.
Okay.
For instance, if you happen to export 90% and sell 10% in the local market, then that company cannot invoke the 14%. The company will have to pay at the rate of 28% for both export portion as well as the local sales portion. So, that's, I don't think it's a welcome feature at all.
Yeah.
And from the point of view of the exporters of services, current law, there is an exemption. If a person is providing a service to a person outside Sri Lanka and that person pays in foreign currency and that foreign currency is bought to Sri Lanka through the banking system, at present there is no income tax liability.
Okay.
Now, that income tax provision will not be there in the new bill. In other words, the foreign currency earners, the service providers who are foreign currency earners would be exposed to tax at the rate of 14%.
Right, that should attract a bit of interest considering. So basically, if I were to sum it up, when you're looking at the export of goods particularly, you need to be 100% exporter in order to be recognized under the act and through the 14% benefit,
14%, yeah.
which is compared to the 12%, and the entire exemption on the export of services will be taxed depending on whatever the applicable individual or institutional rate going forward.
Yeah, that is if you don't export 100%.
Yeah, on the services side, it's going to be taxed at whichever the applicable rate.
14%.
At the 14% itself.
Yeah, for that exclusivity aspect of it is not there in case of exporters, right? Currently, at present, the exporters of services are not liable for tax, and there will be a 14% tax on their foreign currency earnings going forward.
Right. We looked at the major sectors, the export sector and the financial sector, and of course the implications of the new bill. What can we say the more other significant sectors which can be exposed, which are currently exempted and newly which might be introduced from the Inland Revenue Act as well?
Okay, let me put it this way. Under the current act, there are four bands in relation to the rates. Right? We have 10%, and then we have a 12%, and then we have 28%, and let's say the high rate works out to the 40. Now, that's going to change, and it will be only three rates, that is 14%, 28% and 40%. So, you will have, let's say, liquor industry or tobacco going at 40%, and standard rate will be 28, and the 14% will be applicable for a few industries like SMEs, agriculture, and education, so and so. And industry like say construction currently is at 12%, and that some of the 12% industries went up to 14%, but areas like, let's see, construction, health, that will go from 12% to 28%.
Right. So that's a significant area, I mean a change which can be expected on the construction and healthcare as you mentioned.
Correct.
Right. How would we look at the new Inland Revenue Act from the perspective of attracting or motivating foreign direct investments going forward?
Okay, let's look at this. Now when you say how do you use tax as a tool to encourage FDI, there are different views in relation to this, but in the bill there are no tax holidays for any investments. But there's this concept of enhanced depreciation allowance instead of tax holidays.
Okay.
So depending on the criteria, for instance, let's say if you have an investment above 3 million USD, and depending on the employment generation, there are different figures, and the other criteria like the geographical area, there are enhanced depreciation allowances. So that's one key thing that you can see
With regard to the
FDI. Right. It's not only for FDI, but then of course that will be the incentive that FDIs can rely upon.
Right. Any other areas which you would like to put across for investors in terms of interest areas where the new Inland Revenue Act will have any implications for Suresh?
Well, for large investments, again there's accelerated depreciation and certain exemptions, certain concessions with regard to dividends, etc. That's if the investment is over and above 2000 USD million, 2000 million USD. So there are concessions.
Right. So I think if we were to kind of recap on the position, we are still, I mean, it is running its course and being fine-tuned before the approval and the committee stage comes
Yeah,
across.
I think there will be many changes in relation to at the committee stage policy issues as well as the drafting. I expect there will be major changes during the committee stage period.
So, I mean, ballpark wise, would you be expecting a time period for the bill to actually come into effect?
Okay, that's your first question. I did not answer
Yes.
at that time. So let me put it this way. In the bill, in black and white, it's there to say that it will be effective from 1/4/2017. That means we are talking about going back retrospectively. But at the same time, there are indications coming from the relevant authorities that it will be effective from 1st of October 2017. But at the same time, there's lobbying going on to ensure that the implementation will be from 1/4/2018.
Okay.
And in my personal view, I think 1/4/2018 would be the better date to implement it.
That is the tax year and would probably reduce any
Correct.
complexities.
It will not be. So you're not implementing it from in the middle of a financial year.
Right. So there you have it, the new Inland Revenue Act, which is yet to come into play, and it is before the committee stage meeting, and it's running its course in terms of being fine-tuned. We hope the nitty-gritties which we brought across in terms of an investor view from a macro perspective of the FDIs, the export sectors, and in terms of you as an investor, what implications it's going to have for you will be beneficial in your investment decisions for tomorrow. Thank you for joining us, Suresh. Thank you very much for making time. And that's all from us at Market Watch. We hope you will join us next week for another episode.